Thank you for coming along to see today's session, which is a quick 15-minute dive into pension contributions if you're earning over 100,000. This is a really short, sharp webinar for you to just get a few bits that might prompt you to do some more research or to take a bit of a deeper dive into our YouTube as well to learn a little bit more. But a little bit about me. My name's Lisa. I'm a chartered financial advisor. I'm also a fellow of the Personal Finance Society. And I've been in the industry now more than 20 years. So hopefully you feel that you're in very good hands today. The most important thing for today is this is not advice, this is just information, as I said, that will hopefully prompt you to realise whether or not you need help with these things. So this is our team, our growing team. So the thing I wanted to make clear to everyone is that 95% of our clients, before they come to us, have never ever taken advice before. So we've really built the service around holding people's hands from the very beginning all the way to being a wealth client at the end. So most people start with a financial diagnosis session. They cost £500, and that's an opportunity to spend an hour with us where we can pinpoint all the things that you could be doing to improve and to answer some really important questions like, are you on track? And if not, what do you need to do? Then we have an accelerator, core and high net worth, leading all the way to the wealth clients who have over £1 million with us. So diving into what you're here for is firstly, to get your head around pension contributions, you really need to understand how income tax works. So Scotland have a slightly different one. So if you're in Scotland, do look this up. But the 0 to 12,500 just over is 0%. So this is the personal allowance. Then it goes into the 20% tax threshold. So you pay money on that slice between £12,000 and £50,000 at 20%. Above that, you enter the high rate tax threshold where you pay 40% all the way up to 100. Now, this is where it gets complicated. And honestly, I see so many people who actually don't realise they're paying the 60% tax bracket. And the 60% tax bracket occurs because you are paying 40% tax, but also for every pound you earn over 100,000, you're losing 50p of this personal allowance. So it creates a 40 plus 20% marginal rate of tax, which is where we get the 60% tax bracket from. And then above 125,000, it goes back down to 45%. So if you're really, really above this, next month we're going to be doing a whole other session on what to do if you're earning over 260,000. That's a good one to watch if you're in that bracket, or you think you're going to be in that bracket in the next 3 to 4 years as well, because there's some good planning that you can do now if you will be. So remember where you are and also how much you're over. So if you're earning, say, 150, you're £50,000 above that. And that's ideally a good amount to see if you can do to put into your pension. We want to use your pension contributions to manipulate legally, very legally, which tax bracket you fall in at the end of the tax year. And so now is an ideal time to get all your ducks in a row, get your pension contributions through work at the right level to make sure that you're manipulating your tax correctly. If you're married or in a civil partnership, it's also important to notice where your partner is as well. And are they just above one of these thresholds where increasing their pension slightly can also help them out, so that as a couple between you, you're very tax efficient. So pensions really are the high earners tax planning opportunity. They're one of the most tax efficient wrappers available to us in the UK. And how it works, we've got a webinar called Ways to Pay into a Pension, which you can see on our YouTube channel. We'll send that around afterwards too. But in there, if you're doing it through your company, through salary sacrifice, the tax relief is already happening. If you're paying money into a personal pension, let's say, or through the net pay method, through your employer pension at work, what happens is you pay in £80, the government pays in £20, and you have got your 20% tax relief back there. However, if you're a 40, 60 or 45% taxpayer, you need to claim the difference back. So if you've only had 20, but let's say you're a 60% taxpayer, you're going to need to get 40% tax back, and you're going to want to do that through your tax return. So now is really important to have a look. Did you make any pension contributions last year? And do your tax return as soon as possible, because maybe they'll owe you, and then you'll get a rebate. Some interesting food for thought. £3.5 billion was overpaid in tax in the 24-25 tax year by 5.6 million. Just less than a third of that was from unclaimed pension tax relief. So if you're not claiming your pension tax relief properly, definitely start, but you can also go back tax years as well to claim back unclaimed tax relief. So make sure you do that as soon as possible. When you get that tax rebate back, let's say you do your tax return for last tax year now, that money's probably going to be with you within 6 to 8 weeks. That rebate that you're getting from your pension payment can then go into fund the 𝗖𝗓 payment. So you can get into a really, really positive cycle. The first year is going to be painful because you've got to upfront the money. The second year will be amazing because you're getting your tax rebate, you're using that to fund your 𝗖𝗓, and then your own cash to fund the pension. So you can get into a really, really nice cycle with it. And if you're earning over 260, make sure you look out for next month's webinar. The annual allowance. So the government doesn't anymore, sadly, just allow you to pay in huge amounts into a pension. They cap it because they don't want to give away too much tax relief. For most people on this call, you have a pension allowance of £60,000 a year. And the rule is you fill the year that you're in between you and the employer, and then you can go back to the previous 3 tax years and pull forward any unused allowances. So for example, I would fill this year, the current new tax year that we're in, and I would then go back to the 23-24 tax year. If I don't use this tax allowance, this pension allowance, in this tax year, I'm going to lose it. But this one can be carried forward for 1 more year, and this one here can be carried forward for another 2 years. So you can really plan. One thing to think about is how much do I need to pay in to manipulate my tax bracket, but also how much do I need to pay in to make sure that I'm not losing any unused allowances as well. This is exceptionally important if you feel you're going to be a big earner in the not too distant future. So at its worst, very high earners can only pay £10,000 a year into a pension. So if that's going to be you in the future, it's really important that you're getting these allowances while you can to really boost your pension before you don't have that power anymore. So the other thing to consider, and I'm not going to touch on it too much, but if you, one benefit of getting your pension, your earnings, below the 100,000 threshold is you get the 60% tax relief back. But if you've got children, it allows you to get the free hours for preschool children. You can even think, if I've got kids, can I manipulate my income so that I'm earning below the child benefit threshold as well? Something to consider for you, and if you're married, partner as well. So these are the things that we see regularly, the problems that we see clients fall into. Unintended taper exposure. Now that just sounds like jargon, but what it means is, let's say I'm on a salary of 150,000, I'm paying in £60,000 a year into my pension through the employer and me, thinking I'm winning in life, and then an employer will give me some stock, it'll give me an unexpected bonus, and suddenly I've now got a reduced annual allowance, and then you have to pay tax charges. We had a client last tax year had to pay back £120,000 in pension contribution. So it's really important to stay on top of it. Obviously, clients, if any of you are on the call, we're on top of this for you as well. I just had an email today from a gentleman who's opted out of his employer pension. I have a call this afternoon because I think by doing that, he's missing out on this free money from his employer. So whatever you do, please make sure that you check what do you need to do to get the most out of your employer on the pensions side of things. Lots of people have pensions all over the shop and they're not keeping an eye on them. And some of these pensions are doing well, some of these pensions aren't doing well, but it's really important that you track them down. The government has a pension tracing service. If you just Google it, make sure that you go on the .gov website, because there are some charlatans out there trying to charge you for that service. But it's really important that you get your get some oversight on those pots and take control of how they're invested. A lot of people have risk mismatches, so we'll see someone might want to retire at 55, but their pension's geared up to retire at 67, so they're not aligned in the correct way. But I think most people, if they're honest, when they are doing their pension planning, especially if it's automated through work, they're not doing it in an intentional way. They're not matching their goals and their choices for retirement with what they're doing in their pension. So it's really important that you match those. And I'm going to give you a bit of a checklist so you can start doing that as well. So here's a 4-step program that you can follow. So the first one is clarify the target. So understand what it is that you really, really want. Obviously, we help people with this all the time. So if you need our help, let us know. Then you want to make a list of all the assets that you've got that you're going to have for retirement. It doesn't just have to be pensions. It can be ISAs, general investment accounts and such like. And then you want to match with that, what contributions are you paying into a pension, so from you and the employer, sorry. Next, you want to look at your tax optimization to see which tranche you're going to be in, and then if you can fall into a different tax bracket. And then the last one is reviewing all of those pots that you've got to make sure that they're aligned with your risk and costs. And if sensible, you're consolidating, but that you set regular reviews. So I would recommend doing at least 6 monthly reviews of your pot. Well, I love it, so I do it monthly to track. Oops. 50% of people over 50 won't have enough saved for a comfortable retirement. I think this is probably the most scary slide of today, but it's really, really important to think about. We don't have those safety nets, or don't usually have those safety nets in place like past generations did with defined benefit pensions. The state pensions, we know it is unaffordable going forward, so maybe changes that like that with the state pension will affect us in the future. So it's really important to make sure you're on track and in control. This is an example of something that we'll do with a client. You can get these kind of tools online. They're called cash flow analysis tools. This is one that we use called Voyant, and we'll sit down with a client. So this client's told me ideally they want to retire at 55. Maybe 60, but definitely not past 60. This is a real life example. And here in red, you can see if the client continues doing what they're doing, they're going to run out of money at 55 if they don't change what they're doing. Or at 60, they'll run out. If they retire at 60, they're going to run out of money at 76. So above on the right, you'll see for this person to retire at 55, they either need to get 8.2% a year, save an additional 300,000 over the next 10 years, or they need to reduce the amount that they're spending because they're only on track to have an income of 58,000, which I know lots of people would think is plenty. To retire at 60, they need to either a 6.4% return, they could afford to spend £77,000 a year, or they need to save an additional 130,000 over the next 15 years. So often at the end of a financial diagnosis session, when we've built one of these for clients, we're going to walk away and say, well, I know the returns I need and I know the amounts that I've got to save, and then you can be benchmarking yourself against that target. So I think they're very, very useful. It's a reminder of the services. So the first port of call that I just showed you there is the financial diagnosis session. Accelerator for those just starting out. So you've got £0 to £250,000 in your pot. We'll put everything all in its place, get everything invested so it's automated, but we don't charge any ongoing advice fees or anything like that. The cost of the financial diagnosis session, which is £500, is always deducted against the cost of any advice that you take out in the future, and we'll hold it on account for you as well if that doesn't happen straight away. So that was a 15-minute whistle-stop tour of pensions. I think the most important thing is to make this time useful is to think about what's the biggest takeaway, what actions are you going to take from today and by when to make sure that you have made this time worthwhile for you. There are lots of ways that we can help as well. although we do run a financial advisory firm, we're really, really passionate about making sure that financial education is out there and good information is out there. So you can follow me on Instagram, you can follow the company 𝗪𝐶H Wealth on Instagram as well, put regular content out there to help inform people. We also do a fortnightly newsletter, which is jam-packed full of lots of information and updates about what's going on in the industry. And obviously we're here to help you if you feel you're ready for that next step to be a client. The financial diagnosis sessions, as I mentioned, are £500. And that's it. So I hope you found it useful. Everything will come round to you in an email, so you can also book on next month's one. The following month, if you're not earning over 260,000, June's one, we've got a bit of an Instagram star coming on, talking about tax and when not to do a tax return. So I hope that session will be really, really useful. So yes, thank you very much for spending your time with us, and I hope you found the session useful.